Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me.
So, imagine checking your stock portfolio right now. You see that, I don't know, a major international artificial intelligence company you invested in is up like 10% for the year?
Right, which sounds great.
Exactly. You feel like a genius. You hit sell, ready to cash out your massive gains, only to find out that your actual take-home profit is practically zero. You haven't made a single dime.
Yeah, it's brutal.
How is that even possible? Today, we are exploring this invisible currency war that is quietly stealing those returns from you. And it all starts with the massive chain reaction radiating out of the Middle East.
It really is a phenomenon that catches so many beginner investors off guard, you know? When you buy international stocks, you are fighting battles on multiple fronts without even realizing it.
Right. And for a U.S. investor right now, especially navigating the current economic landscape under the Trump administration, the U.S. dollar feels like an absolute fortress.
Oh, absolutely. It's incredibly strong right now.
I mean, our domestic economy looks robust in a lot of ways.
Yeah.
But recent analysis shows how that very same strong U.S. dollar, when colliding with the ongoing conflict in Iran, is creating this hidden shock wave across the globe.
Yeah.
Specifically, it's tearing through Asian market.
Yeah, that's the core of the issue.
My first instinct when looking at tension in Iran is to just think, okay, this is an oil crisis. We've seen those before. But the data suggests this is something much more complicated. Okay, let's unpack this.
Yeah, it is much more complicated. The research indicates that we really need to stop thinking of this purely as an oil shock.
Okay, so what is it then?
We need to start recognizing it as a massive Asian FX shock.
FX meaning foreign exchange, right?
Okay. Exactly. The value of different national currencies. To grasp why this is happening, you have to look at the physical flow of global energy. Asia is overwhelmingly dependent on the Middle East to keep its lights on.
Right, to run the factories and everything.
Yeah, exactly. In fact, data shows that Asia imports roughly 80% of its seaborne oil right through the Strait of Hormuz.
Wait, 80%?
80%.
Which is a notoriously narrow and, like, highly sensitive choke point.
Mm-hmm.
So when military tensions spike in Iran, the perceived risk of that strait becoming impassable just skyrockets.
And we have the pricing data to show the immediate impact of that fear.
Right, like as of June 5th, 2026, Brent crude oil, which is the major global benchmark price, right?
Correct.
It was sitting at over $93 a barrel, $93.09 to be exact. And meanwhile, WTI, the U.S. domestic benchmark, was up over $90.
Right, $90.54. So baseline energy is incredibly expensive everywhere.
But I'm stuck on something here. I get that oil is up, but how does that connect back to the U.S. economy? And more importantly, how does a supposedly positive U.S. jobs report end up punishing a guy in Seoul just trying to fill up his gas tank? Walk me through that invisible string.
It's a brutal sequence of events, and it really highlights how interconnected the global financial system actually is. Let's trace the string. Step one.
Okay.
Oil prices sit in the 90s. That automatically drives up inflation inside the United States because, well, every single product on a store shelf has to be transported.
Usually by diesel trucks, yeah.
Exactly. Step two, you combine that rising transportation cost with the shockingly strong U.S. jobs report we just saw for May.
Right. The economy added, what, 172,000 jobs?
Yeah, 172,000 jobs. And unemployment held perfectly steady at 4.3%.
So more people working means more people spending, which usually pushes prices up even further, right?
Exactly. Now, put yourself in the shoes of the new Federal Reserve Chair, Kevin Warsh. His primary job is to keep U.S. inflation under control. If he sees high oil prices and a hot labor market, he has absolutely zero room to lower interest rates.
Because lowering rates would just make inflation worse.
Precisely. In fact, the market starts betting he will be forced to keep rates high for a very long time or even hike them. We saw this reaction instantly in the bond market.
Well, yeah, the two-year yield.
Right. The U.S. two-year Treasury yield, which is basically the return you get for lending the U.S. government money for 2 years, it jumped to 4.15% right after that jobs report.
Okay, I follow the U.S. side of the equation. High oil plus strong jobs equals high interest rates. But how does that trigger a currency shock over in Asia?
Think of global investment capital like water in a slightly tilted bathtub.
Okay, a bathtub.
Yeah. When the U.S. Federal Reserve keeps interest rates high, offering investors a guaranteed safe return of over 4%, they are effectively lifting one end of the tub.
Oh, I see. So the water just rushes away.
Exactly. The water which is the money, has no choice but to rush toward the deepest end. It flows aggressively into the US dollar. Global investors sell their foreign currencies and buy dollars to get those high yields.
Ah.
Consequently, the US dollar becomes this giant, powerful magnet. It gains value while currencies in places like Japan and South Korea drain away and lose value.
And here's the fatal blow for those Asian countries, right? Oil is universally priced in US dollars.
That is the crux of the crisis.
Right.
If you are an Asian nation, the baseline cost of a barrel of oil has gone up because of the war risk. But simultaneously, your local currency has lost massive value against the US dollar.
So you need more of your own currency just to buy a single dollar?
Before you can even attempt to buy the oil.
It's like going to your favorite coffee shop and finding out the price of coffee went up. But at the exact same time, your boss cut your paycheck. You're getting squeezed from both sides.
Yeah, that is a very accurate way to visualize imported inflation.
I mean, your expenses are up and your purchasing power is down.
Exactly. The citizens of these countries are suddenly poorer, not because their local businesses failed, but due to entirely external geopolitical forces.
Wait, looking at the data, there are rumors of peace talks swirling around the Middle East all the time, right?
Yeah.
If I wake up tomorrow and see a headline that the U.S. and Iran made a deal, shouldn't oil prices plummet and fix this whole mess instantly?
What's fascinating here is the sharp distinction between headline news and actual supply chain normalization.
Okay, what do you mean?
Well, the recent analysis points out that Iran has been seeking partial, temporary agreements. The strategy isn't necessarily to end the conflict forever.
Right.
It's often about relieving immediate domestic economic pressure while continuing to protect strategic assets.
Yeah.
Like their nuclear program, they are buying time.
So a treaty is basically a political band-aid, not a logistical cure.
Exactly.
And we actually saw the market get faked out by this recently, right?
Yeah.
Early June, oil prices were fluctuating wildly on every whisper of a peace rumor.
Yeah, Brent crude shot up to $96 a barrel.
And then immediately fell back down when traders thought a truce was imminent.
Right, but see, market algorithms react to headlines in milliseconds. Physical cargo ships do not.
That makes sense.
Even if a comprehensive peace treaty is signed tomorrow morning, you cannot magically fix the logistics of the Middle East by the afternoon.
Right, you still have to move the actual oil.
Exactly. First, you have to verify that the Strait of Hormuz is actually clear of lingering military threats. Sea mines, rogue drone activity. That takes military coordination and a lot of time.
And I imagine the insurance companies aren't just taking a politician's word for it.
They absolutely do not. The massive global maritime insurance syndicates have skyrocketed their premiums for any vessel entering that region.
Because of the war risks.
Right. And it takes months of sustained, proven stability before those actuaries will lower premiums back to normal levels. On top of that, you have to reposition fleets of tankers, normalize freight schedules.
So until those ships are moving freely, safely, and cheaply again, the delivered price of energy to Asia remains a heavy burden.
Exactly.
So if a rich country like Japan knows that the ships aren't returning to normal anytime soon, what do? Because the logistical reality is crushing their economy right now. I was looking at South Korea and Japan, and the numbers are just staggering.
They really are. Let's look at South Korea first. The Korean won recently collapsed to around 1,550 per US dollar.
Wow.
To put that in perspective, that is the weakest the won has been since the absolute depths of the 2009 global financial crisis.
And that weak currency translates directly into pain at the cash register for the average Korean citizen, right? South Korean inflation is currently sitting at 3.1%.
Yeah, and when you dig into the components of that inflation, you see a massive 24.2% jump in the price of petroleum products alone.
24%, that's insane.
It is. The Bank of Korea is completely backed into a corner. They recently held their interest rates at 2.50%, but the internal data suggests they might be forced to hike them to 3% soon.
Just to stop their currency from bleeding out.
Exactly. Purely defensive. And then you have Japan, which provides this incredibly dramatic case study in how hard it is to fight the gravity of the US dollar.
Yeah, the yen.
Right. The Japanese yen recently crossed the psychological threshold of 160 per dollar. To fight this, the research shows Japan intervened in the currency markets. They spent over $73 billion in late April and May alone.
Wait, 73 billion?
Yeah, which equates to about 11.7 trillion yen.
Throwing $73 billion at a currency problem just to watch it fall anyway? That's like trying to stop a flood with a single bucket. The water, or in this case, the US dollar, is just too strong.
It is the exact mechanism. They dumped billions of US dollars to buy yen to create artificial demand. But
Yeah.
the fundamental math of the global economy was so heavily weighted against them.
The market just absorbed it.
Yeah, the market just absorbed those billions, and the yen fell right back to 160 anyway.
That tells you everything you need to know about the current strength of the dollar. The structural difference is just too wide. The U.S. offers high interest rates. Japan historically offers incredibly low rates, right? And the cost of importing energy is eating Japan's trade balance alive.
And because that massive intervention failed, the Bank of Japan is facing a historic shift. They're now widely expected to hike their interest rates to 1% in mid-June.
Which might sound tiny to an American investor, but for Japan, a country that has essentially structured its entire modern economy around zero or even negative interest rates for decades, a hike to 1% is monumental.
It's an earth-shattering shift for them.
But let's look at the broader map here. If a highly developed, wealthy nation like Japan can't even buy their way out of this crisis with $73 billion, what happens to developing nations that don't have that kind of cash lying around?
The emerging markets are being squeezed even harder. They're being forced into a very painful policy corner.
Growth versus defense.
Exactly.
Yeah.
They must choose between sacrificing their own domestic economic growth or defending the value of their money.
Okay, I have to play devil's advocate here. If I'm a country like Indonesia or India, why not just let my currency fall? Why raise interest rates and hurt my own citizens' ability to borrow and grow?
If we connect this to the bigger picture, the alternative is societal collapse. Remember the fundamental rule we established?
They have to import their energy.
Right. If they simply let their currency go into a free fall against the dollar, the cost of oil, natural gas, and often imported food becomes completely unaffordable overnight.
Oh, so you don't just get inflation.
No, you trigger hyperinflation. If citizens literally cannot afford the fuel to drive a truck or run a power plant, the economy stops entirely. So they are forced into this terrible economic posture.
Tightening amidst slowing growth. They're slamming on the economic emergency brakes while the car's engine is already sputtering.
Precisely. And you can see the panic in the actions of their central banks. Look at Indonesia.
Right.
The Rupiah hit record lows, dipping into the 17,700s against the dollar and threatening the critical 18,000 line.
So what did they do?
Bank Indonesia executed a panic hike. They aggressively raised their interest rates by 50 basis points, bringing them to 5.25%.
And for anyone unfamiliar, 50 basis points is just half of 1%, which might sound tiny to us. But in central banking, pulling the lever that hard and that fast is a desperate defensive maneuver.
It is a giant flashing red light, and India is fighting the exact same storm.
Do they hike rates too?
Actually, analysis shows the Reserve Bank of India managed to hold their rates at 5.25%, but they used incredibly aggressive tactics behind the scenes.
Like what?
They used targeted tax breaks and complex foreign exchange swaps to artificially lure between $40 and $60 billion in capital into the country.
Wow, just to build a fortress around the rupee.
Exactly. Meanwhile, the Philippines is publicly stating they're considering off-cycle emergency rate hikes.
Meaning they aren't even waiting for their scheduled monthly meetings anymore.
Nope. They are fighting a day-by-day battle against the dollar. The capital they are burning just to survive is permanently eating away at their internal growth potential.
So what does this all mean for you, the listener? We've covered a massive amount of ground here, from the logistics in the Strait of Hormuz to the panic in Asian central banks. But how does a beginner U.S. investor actually use this information?
That's the most important question.
Right. Let's bring this macro theory back to your brokerage account. Because right now, the entire retail investing world is obsessed with the boom in artificial intelligence. People are buying international tech stocks and completely ignoring the currency angle.
Which is incredibly dangerous.
It is. Focusing entirely on AI stock growth right now without looking at currency is like buying a shiny new sports car but completely ignoring that gas just went to $20 a gallon. The vehicle is great, but the environment makes it a bad ride.
The sports car analogy is highly relevant here. It perfectly encapsulates what analysts call the AI trap.
Okay, break down the mechanics of this trap for me.
Suppose you buy stock in a massive South Korean semiconductor or AI company, someone like Samsung or SK Hynix. You watch the charts and you see that the stock itself went up by 10% on the Korean exchange.
The business is doing great.
Yeah, underlying business is flawless. So you hit sell, but here is where the trap snaps shut. Your profits are currently denominated in Korean won.
Right. But I live in the U.S.
Exactly.
Get it.
So your brokerage automatically converts those won back into US dollars. As recent data points out, the Korean won has lost between 5 to 8% of its value against the dollar.
Oh, man. So the currency exchange rate essentially eats your stock market gains. The 10% you made on the stock is offset by the 8% you lost on the translation.
Exactly. What truly matters to an international investor are dollar-based returns. If the foreign currency is collapsing against the dollar, your investment is bleeding value in translation.
Even if the company's fundamentals are flawless.
Right. The overarching macroeconomic environment is actively destroying your take-home profit.
That is such a critical lesson. You aren't just betting on a foreign company. You are fundamentally placing a bet on the strength of that country's currency against the dollar.
Precise.
So, if international tech is a trap right now, what does the research say about defense? How do you shield a portfolio?
The analysis suggests you have to invert your thinking. If Asian energy importers are the ones suffering, look at who is standing on the other side of that transaction.
The sellers.
Yes. Look at the energy sector itself. Specifically, companies involved in liquefied natural gas, or LNG, and major refineries. While high prices act as a heavy tax on Asian economies, they provide a massive revenue boost for energy producers and infrastructure companies.
Because they're the ones selling the $20 gas to the guy in the sports car.
Exactly. These companies typically offer strong, consistent dividends and generate high cash flow. In a volatile world, that steady cash flow acts as a fantastic defensive shield for your portfolio.
And on the flip side, the research is clear about the victims here. If central banks in Japan, South Korea, and Indonesia are aggressively raising rates, it makes borrowing money incredibly expensive.
Right. Therefore, the analysis warns investors to be highly cautious of Asian real estate developers, local consumer goods companies, and high-leverage growth stocks.
Because high leverage means they rely on borrowed money.
Exactly. When rates are near zero, that works beautifully. But when central banks panic and hike rates, that debt suddenly becomes overwhelmingly expensive to service. Those companies simply cannot sustain their operations or justify their high valuations.
It is truly a global domino effect. It starts with tension in the Middle East, travels on an oil tanker to Asia, forces central banks to panic hike, and ultimately decides whether your tech stock makes or loses money.
It is all deeply invisibly connected, and if I can leave you with one final provocative thought, something to really chew on.
Please do.
If global markets are currently being dictated almost entirely by the gravity of the US dollar and US domestic data, it raises a fascinating question about globalization.
Right.
Are we entering a new era where investing internationally isn't actually diversifying your portfolio, but rather just placing a disguised bet on the strength of the US dollar?
Wow. That is definitely something to think about. Don't forget to subscribe and hit that like button.